Okay, and welcome back, students who are taking financial accounting, and we're working on the Chapter 5 short exercises in a series of videos, that were signed in your digital study guide for you to do. Last one we worked on was 11, so we're going to pick up with 12. And again, if you're not understanding something, watching the video is the application. If you're making a mistake, that's the application part. But if you're not understanding why you're making that mistake, then that's obviously you don't understand the concepts, and you should go back to the textbook and the theory videos and review those. And if you still don't get it, then speak with an instructor. So hopefully mistakes that you're making are only application mistakes. Right, 5-12. Inland Industrial Supply income statement data for the year ended October 31st, 2014 is as follows. Assume that the ending inventory was actually overstated by $2,800. What were the correct amounts for cost of goods sold and gross profit? Okay, so it helps to just put numbers in place, okay, in order to get a better idea to work through these problems. I mean, if you've done it enough and you understand the concept, you can go right to the gist of things. You can just deal strictly with this $2,800 as being overstated, because you know that inventory, right, is an asset, and we need to decrease our inventory because it's overstated, right? And if we decrease our inventory by $2,800, that means our cost of goods sold should go up, right? And then if our cost of goods sold goes up, that means our gross profit decreases. That's understanding how things work, the overall concept of, what's my relationship between inventory and cost of goods sold, okay? And that is reflected here on my income statement. And then of course I take my sales less my cost of goods sold, and whatever effect that has there is obviously going to affect my gross profit. That's understanding the overall concept, but it sometimes helps to just put numbers in place. So let's say, and we make something up and we use easy numbers. So let's say my inventory is 100,000, okay? And now let me make it 102,800. 102,800, right? Now, it says it was overstated, meaning that there's $2,800 too much in the inventory account, right? Well, if I have $2,800 too much in the inventory account, that means I have to take the $2,800 out, right? Which would give me an inventory of 100,000. Okay. Now, when I take the $2,800 out, what's my journal entry going to be? Well, if inventory is an asset and I decrease my assets on the credit side, right? So I'm going to credit my inventory by $2,800, and debits have to equal credits. So where am I going to put it? Well, I'm going to put it to cost of goods sold, right? So that's my journal entry. Now, and that's how I go from that inventory goes to cost of goods sold, right? Which is what we're looking here. So if my cost of goods sold now increased by 2,800, so I have 136,400 plus 2,800, I have $138,200, right? So let me write this down here. I actually should have just put that in a different place, so let me erase that real quick and stick it up here. So I have 136,400 plus 2,800, 139,200. Sorry about that. So if over here Now my cost of goods sold changed, so I have 253,700 less 139,200 for my cost of goods sold, right? Which now changes my gross profit by, let's see, 5,411. So my gross profit now is only $114,500. Okay, so hopefully you followed along in that thought process. I mean, I didn't, because I understand the relationships and the underlying concepts, I know that when I can think it through, that when my inventory is overstated, that means my cost of goods sold, when I take it out of inventory, that decreases. My cost of goods sold increases. So I would have just mentally, I would have said, okay, I would have added the $2,800 to the $136,400, which gave me $139,200, and I would have done the math in order to get my gross profit here at $114,500. That's what it should be, because since it's overstated, I have to make the adjustment to bring it back into the correct actual amount. But again, if you need to walk through the numbers to see how everything kind of like works out, make something up. Okay, you don't have to have the data. You don't have to be given information in order to be able to work with concepts. So it doesn't matter whether I wanted to use 100,000 here or I use 200,000, 300. Doesn't matter. Okay, I pick a number. Okay, I could have just as easily picked 9,725. Okay, and then subtracted $2,800. Okay, it doesn't matter what that initial number was. What matters is that, I know that I'm decreasing my inventory, and when I decrease my inventory, which is what we do here in the journal entry, I increase my cost of goods sold. And when I make that journal entry and I post it to my ledger accounts, remember these are ledger accounts right here. Okay, this is a ledger account and this is a ledger account. Okay, so when I post it to my ledger account, that's going to change that balance, and this is then that effect of that change. All right, hopefully you got that. If not, pause the video, go back and watch it again, and if you still don't understand it, feel free to contact an instructor. All right. All right, 5-13, inventory errors. Inland Industrial income statement for December 31st has this information. Same information as the last one. Assume that the ending inventory was accidentally overstated by 3,200. How would the inventory error affect cost of goods sold and gross profit for 2015 if the error is not corrected in 2014? Okay, so this basically is the same as this one here. Okay, if we're overstated by 3,200, okay, and this here is at the end of 2014, this isn't corrected. All that we're doing is just the ending balances from 2014 become the beginning balances for 2015. So our 2015 inventory is overstated right from the start, right, by this 3,200, right? And the question is asking, how would the inventory error affect the cost of goods sold and gross profit for the end of 2015? Well, this is no different than 5-12. Okay, our cost of goods sold is understated, which means our gross profit is overstated. Okay, so rewind the video here and look at 5-12, and you'll just see instead of using $2,800, all I'm doing is replacing it with $3,200 when you use the numbers, and they threw in this little bit of extra here by saying, okay, this is 2014. We don't make the adjustments. Now what's the problem with 2015? All we did was we just perpetuated that mistake. Okay. And we just carried it over from year to year. And so really nothing is any different than what happened in problem 5-12. So rewind the video, and like I said, if you didn't understand 5-12, you can watch it again, and that also helps you with problem 5-13. Right, so I only have 2 more problems left here, short exercises 14 and 15, and I'll cover those in the next video.